Good afternoon, participants. Today we are going to discuss a very important topic known as terms of payment and export finance. As you all are aware that in the export-import business, your buyer is located in different places and seller in different places, in different countries. So when both of them are located in different places, different countries, it becomes sometimes very difficult for you to procure the order. Now, in order to procure the order in the most effective way, you need to formulate, you need to develop the terms of payments as favorable to the buyer. Now, if the terms of payments are favorable to the buyer, the chances are that you would be able to clinch the order. Now, the terms of payments are determined by number of factors. For example, exchange control regulations, terms of trade practices, financial position of buyers, bargaining strength of buyers and sellers. Now, it depends that how you are going to manage the terms of payment so that one party is being attracted towards your order and you are able to fulfill the export consignment procedures. There are different modes of terms of payment. You have advance payment, you have documentary credit, you have on the payment on the consignment basis, you have the periodical settlement of the payment, like that. So today we are going to discuss all these terms of payment and plus how you are going to get the pre-shipment, post-shipment credits, etc. So today we are going to discuss all these things in detail. We are going to run this session from 12 to 12:45 and these things will be discussed in detail. In order to discuss both the topics in details, we have Professor V. Saran, who has been Professor and Dean Magad University earlier. Again, he was a former UGC visiting professor in the Department of Commerce, Delhi School of Economics, University of Delhi, Delhi. So now before I hand over the mic to Professor Saran, I would like to request you that whenever you find any problem, if there is any query, you are most welcome to ask the questions and we will be happy to respond your answers. If you do not find time to talk to us directly, you may also fax the questions. The telephone numbers would be shown on the screen. You may call us or you may fax the questions. Now I would like to request Professor Saran to deliver the lecture.
Good afternoon. Professor Noel Kishore has very nicely introduced the subject to you. In the process of trade, the exporter exports the goods to the importer, and in lieu of that, the exporter receives the payment. Now, there must be some assurance to the exporter that he will receive the payment. There must be some assurance to the importer that he receives the goods in order, according to its specifications. The quantity of goods, the quality of goods must tally with its specifications. So these are very important issues, and in this context, the importance of the documents, export documents, is very much there. What would be the modes of payment, and how should be there the different sources of finance, export finance. So all these issues are very important. Let us talk about, first of all, about the document. Letter of credit is the most important document in the foreign trade. What is letter of credit? It is a document showing the importer's bank making promises to pay to the exporter. So, if the importer's bank makes promises to the exporter that the payments will be made, it's okay, the exporter is assured, and what is the content of the LC? LC means letter of credit. The amount, how much amount has to be paid, what should be the maturity within which the amount has to be paid, and the amount has to be paid subject to the fact that the exports must tally with the specifications of the importer's order. The quality should not be different, the quantity should not be different. And for that issue of the LC, the importing bank charges some amount of fee from the importer. So on the behalf of the importer, importer's bank issues LC, and that way the credit risk which is always there for the exporter, that is mitigated. So the question is, how does LC operate? Importer makes an order to the exporter for the import, how much it has to import, what quality it has to import, what product it has to import, and then on that basis what is the value of the import, and then on that basis it requests its banker to issue LC. Now the importer's bank issues the LC and then delivers the LCs to the exporter's bank. The exporter's bank confirms it, and then it passes on the LC to the exporter. When the LC reaches the exporter's destination, I mean exporter's hand, the exporter makes the export of goods according to the specifications mentioned in the LC, and then it passes on the LCs along with the other documents, export documents, to its banker. The exporter's banker delivers LC to the importer's bank, and then when the goods reach the importer's end, the goods are tallied with the specifications, and if it all is correct, then the importer's bank makes the payment to the exporter and debits the account of the importer. This is how LC operates. Now there are different variants of the LCs. Sometimes it is clean LC, sometimes, or more often it is documentary LC. Documentary LC means that the exporter gets the LC from the importer's bank via its own banker, and then it exports the goods. It deposits that LC with its banker along with the other documents. So documentary LC means when the LC is accompanied by the related documents, and then the LC is passed on to the importer's bank and everything is done. Now sometimes when the exporter knows the importer very well, the exporter knows that the payment for the importer must be made, there is no risk at all. So in that case, the exporter sends the LC directly to the importer without attaching any document. So it is rare, especially when the exporter knows about the importer, exporter knows about the financial position of the importer, the history of the importer regarding the making of payments for import, and if the exporter is convinced, then in that case clean LC is found. The other is revocable LC and irrevocable LC. Irrevocable LC means that when the importer's bank issues LC, it cannot make changes later on. It cannot cancel the LC later on. So it is irrevocable LC. But if the importer's bank makes changes in the LC, in the terms of the LC, if it cancels the LC later on, that is revocable LC. So the LCs may be irrevocable, the LCs may be revocable, and then the confirmed LC and the unconfirmed LC. Normally the importer's bank sends the LC to the exporter's bank, and the exporter's bank confirms it, passes it on to the exporter. But sometimes when the exporter doesn't know much about the importer and it lacks confidence in the importer, then the exporter gets the LC additionally confirmed by some other bank also. So when the LC is confirmed by the exporter's bank as also by some other bank, double confirmation, that is known as confirmed LC. In this case, it is the exporter is more assured about the payment that will be made by the importer. Then we come up to fixed and revolving LC. What is fixed and revolving LC? If the transaction between the exporter and the importer is only once or twice, the LC will be prepared or issued by the importer's bank for a particular amount, for a particular transaction. But if it is a continual phenomenon, every week, every month, every quarter, the exporter exports goods to the importer. It is a continual phenomenon. And so in this case, what happens is that every time the LC is received and pass it on to the exporter's bank and then to the exporter and all that, it is a cumbersome process. So in that case, it is revolving LC. Suppose the LC is for the value of say $500 or $5,000, and once the transaction of $5,000 or $500 is over, the LC does not lapse. It is used for the second transaction, for the third transactions. After the first transaction is over, the same LC is used for the second transaction. If the second transaction is over, the same LC is used for the third transaction, and so on. So this is known as revolving LC. And if the LC is used for only one transaction, that is known as fixed LC. Then the transferable LC and back-to-back LC. In some cases, the producer and the exporter is the same person. In some other cases, the producer is different and the producer exports goods via some exporter. So, if the LC is issued in the name of the exporter and if there is no transfer clause there in the LC, so amount will be paid to the exporter and not to the producer. So, what happens is that some LC is opened in terms of, or issued in the name of the supplier also, and that LC is known as back-to-back LC. And lastly, red clause LC. Because the exporter exports the goods, it has used some amount of money in producing the goods for export, exports goods, and after 3 months or 5 months or 4 months or 6 months, it gets the payment. So within this period, the exporter lacks finance. So if there is a red clause present in the LC, in that case, on the basis of the LC, the exporter can get funds from the bank, normally pre-shipment credit. So if there is red clause in the LC, the exporter is able to get funds for the period when it is lacking of cash. It is lacking cash, desired cash. It will be getting cash only after the payment is made. This is red clause LC. So this is the most important document in the foreign trade. Some of the trade takes place even without LC, but majority of the trade, export or import, takes place with LC, because it is a document assuring the exporter to get the payment. It is a document assuring the importer to get the goods according to its choice or mentioned in the order. Now we come to the modes of payment. Modes of payment are very important, so as to suit both the importer as well as to exporter. Sometimes the payment is made in advance in form of cash. When it is done, it is not done in the normal cases. It is done in cases where the exporter does not know much about the importer. The exporter is not assured that the importer will make the payment. The exporter exports goods to the importer on credit terms based on the fact that it has a risk class approach, and on the basis of the risk class approach he finds out different customers, different importers to whom it has to export, and this analysis is based on the past performance of the importer and the financial position of the importer. If the financial position of the importer is very good, there is no problem in exporting goods to that importer. If the financial position is good, but the past record of the importer is not good, it has defaulted more often while making the payments. So, besides financial position, it is the past history of the importer that is also very important. And if the exporter doesn't know much about the past history and much about the financial position of the importer, then it likes that the payments should be made in advance. Besides that, in some other cases also, when the goods are exported to order, goods are manufactured to the order. Sometimes in the aircraft industry, you buy an aircraft, you make an order, and according to your specifications, the aircraft will be manufactured and it will be exported to you. So, in these cases, payments are made in advance. Now, the other is payment under consignment sale. Consignment means, in this case, the title to the goods lies with the exporter. Exporter exports the goods to the importer. The title lies with the exporter. The importer will sell the goods, and after selling the goods, he will make the payment. He will not make the payment of the unsold goods. So, normally the risk is involved there. And so, the payment is made only after the goods are sold. Now, the third is payment through draft. What is draft? Draft is a bill of exchange. The exporter is the originator of draft. The exporter is the drawer of the draft, you can say. And the exporter writes the draft, draws the draft, sends it to the importer, and the importer accepts the draft, accepts the bill of exchange. Now, the draft may be a side draft or a time draft. Normally it is a time draft where the importer accepts the draft and promises to pay the amount within a specified time, maybe 2 months, 3 months, 4 months, and so on. That is a normal course of things. But in some cases where the importer is not very creditworthy, in that case it is a side draft. The importer accepts the draft and makes the payment. Again, sometimes there is clean draft and there is documentary draft. Just as LC. When the draft is accompanied by the export documents, that is a documentary draft. And in clean draft, it is not necessary that the export documents should accompany the draft. Now the payment through LC. LC has already been discussed. I have made you known how payment is made under LC. That the exporter exports the goods, it sends the LC to the source banker, then exports banker sends the LC to the importer's bank, and then importer's bank, after the importer gets the goods, tallies the goods with the specifications, and then importer's bank makes the payment and debits the account of the importer. Lastly, there is open account. If the exporter exports the goods only once or twice to the importer, there is no permanent relation between the exporter and importer. In that case, there is no open account. Bill of exchange is drawn, may be drawn once, twice, thrice and 4 times. There is no open account. But if there is a permanent relation between the exporter and importer, every month, every quarter, the goods are exported to the importer. In that case, every time it is very cumbersome process to draw the bill every time and to send it to the importer. So in that case, an open account is there. The importer makes a periodic payment. Suppose every month goods for $5,000 are exported. So the importer makes periodic payment every month, you can say, of $5,000. And no separate bills are issued. So this is called an open account. Now so far we have discussed what is the most important document in foreign trade, what are the different modes of payment in foreign trade, and now we shall discuss something on the financing of foreign trade or the export financing.
Yeah, before we go to the actual export financing strategy, Professor Sharan, whenever we compare this, all the 4 forms of methods of the payment in export business, one question arises that which method is more popular. Once we see the observation in this area that which method is more popular, it appears that the documentary credit method is more popular. Now it is more popular because basically you look, it serves the purpose of both buyer and seller. The answer lies in the basic mechanism of documentary credit, because once you see what documentary credit is, then you find that it is basically arrangement between the parties where the payment is or promise is to be made to undertake payment on the submission of stipulated documents and the terms and conditions. That means it is protecting the interest of both buyer and seller, because the payment will be made once seller submits the stipulated documents and seller complies the terms and conditions of that particular transaction. So here seller is shipping the goods, following or providing stipulated documents and following the terms and conditions. In the same way, the buyer is also making the payment as it has been stipulated in the contract. So in the definition itself, it says that it is protecting to a large extent the interest of both the party, that is buyer and seller. Another things you must take into account, let's see, in the LC, as Professor Sharan has already explained you, that at least you find 4 parties in LC, and those parties are, one is your seller, another is your buyer, and you have issuing bank, then you have advising, confirming or negotiating bank. That means when LC is being opened in favor of the seller, after the opening of the LC, maybe the issuing bank may need the services of advising, confirming or negotiating bank separately, or sometimes all three can be clubbed together. That means the same bank may act as an advising bank, as a confirming bank or as a negotiating bank depending upon circumstances. So now the LC which has been issued by the issuing bank is being advised or confirmed or negotiated by other bank. Then once the document, that is bill of lading, is being submitted, is being provided to that bank, now that bank takes the bill of lading and makes the promises or gets the payment from the importer, then it submits the document to the importer and then it releases the payment to the exporter. So what happens in this way, because it is protecting the several parties' interest, so the methods of payment through documentary credit is a quite or most popular method in the export business.
Professor Kishore, you are very much right in the sense that the buyers are scattered over different countries. It is not possible for the exporter to know about the different buyers in details. So naturally, if there is documentary credit, if there is LC, so it mitigates the risk arising out of this trade. Now we come to the modes of trade financing. If the exporter doesn't have the necessary finance, it cannot export. It cannot produce the goods for export. If the importer doesn't have the necessary finance, it cannot import. So there are sources of finance. There are different channels of finance through which the exporter and importer get the finance. And in this case, the commercial banks are of very much importance. The commercial banks provide short-term credit, normally in two forms, pre-shipment credit and post-shipment credit. The commercial banks extend medium-term credit and in some cases also long-term credit. There is one thing more, credit under duty drawback scheme, that if the exporter has paid duty, if it has paid excise duty, it has paid import duty, and the duty has to be refunded. So there will be some time elapsing between the payment of the duty and get the refund, and during this period the exporter needs finance. So this is credit under duty drawback scheme. And lastly, factoring and forfeiting. These are the different modes of finance, trade finance. Now we will discuss about the short-term credit given by the commercial banks. Now there is Export-Import Bank of India, which was set up in long back in 1982. It also gives pre-shipment credit, post-shipment credit. It is also involved in refinancing. It gives working capital credit and so many type of assistance the Exim Bank of India is giving nowadays. But the most important source of finance is the commercial banks. They provide, first of all, to talk about pre-shipment credit, which is also known as packing credit. The exporter gets credit from the bank for acquiring raw material. For that it needs finance, for getting raw material, for buying the raw material. For processing it also needs finance, and for packaging it needs finance. So the exporter gets pre-shipment credit. Pre-shipment means before the goods are shipped to the importer, the exporter gets credit for acquiring raw material, for processing raw material, and for packaging of raw material. And this credit is normally for 180 days. In very special cases, the period of the credit can be extended up to 270 days. Either a single cash credit account is opened, the bank opens a single cash credit account in the name of the exporter, or there is a rolling settlement account. Every time that the exporter exports the goods, it gets the credit. So, just to avoid this cumbersome process, there is a rolling account under which if the exporter has got the credit, exported the goods, it gets the payment, it deposits back, it repays the loan, credit, and again without opening a new account, it gets further loan for further exports. This is a rolling account. What will be the size of the credit? The size of the credit will not exceed the cost of the goods. The credit is available in local currency, rupees, at PLR minus 250 BP. Prime lending rate, now you know the interest rate is deregulated during the period of economic reforms. The interest rate was deregulated, now it stands deregulated, and the prime lending rate is there. So, it is prime lending rate minus 250 BP. BP means basis points. 1 BP is 1 upon 100 of the 1%. So, 250 basis point means 2.5%. It is less than, because the government is encouraging exports. So, it provides funds, it has asked the commercial banks to provide funds at a cheaper rate to the exporters. The pre-shipment credit is also available in foreign currency at LIBOR plus 100 BP. Earlier it was LIBOR plus 25 BP, now it is LIBOR plus 100 BP, means 1%. What is LIBOR? LIBOR is a rate of interest at which major banks in London offer their deposits. So, LIBOR is changing today the rate of interest in the interbank market, whether it is India, whether it is London, in other countries also. The interest rate, interbank interest rate, changes every day, depending upon the supply position and the demand position for a particular currency. If today, suppose in a particular area, interbank market in a country, the supply of dollars is much lower than the demand for dollars, the rate of interest, the LIBOR, I mean in London, suppose it is in London, the LIBOR will rise. If there is greater supply than the demand, the LIBOR will fall. So, it is floating interest rate, and the exporters can get foreign currency pre-shipment credit at LIBOR plus 1%. And if the LIBOR is very low in the international market, then the pre-shipment credit is available at a lower interest rate. So, there are two benefits of getting the pre-shipment credit. In terms of foreign currency, the exporter gets the foreign currency, number one, and number two, if LIBOR is low, then the exporter gets the foreign currency loan or the pre-shipment credit at a lower rate of interest. So, this is the benefit of foreign currency pre-shipment credit. And then finally, the exporter has to repay the loan, repay the credit. He gets the export proceeds, and after getting the export proceeds, it repays the credit. So, this is known as pre-shipment credit. This is short-term credit. meant for 180 days, in some cases meant for 270 days. Now the post-shipment credit. Post-shipment means when the goods leave the port of the exporter. That is post-shipment credit. After that, the exporter gets the credit, short-term credit, and that is known as post-shipment credit. This credit can be availed in different ways. The banks, in some cases, if there is no LC, in that case, the banks purchase the export documents, and on that basis, the bank can extend the credit, post-shipment credit to the exporter. But in most of the cases, as Professor Naval Kishore told you, the trade is based on the LC, and in that case, okay.
Yeah, Port Blair, please go ahead.
Good afternoon, sir. In terms of elasticity of demand, how can we calculate pre-shipment credit while compiling the cash account and the rolling account for a given period or given year?
Elasticity of demand, in terms of elasticity of demand.
So, what was the question? Please repeat.
Here, as far as elasticity of demand is concerned, see, we are here dealing with the pre-shipment and post-shipment credits. The pre-shipment credit is provided for buying the raw material, processing of raw material, and converting of raw material into finished goods, packaging, etc. So, for this purpose, pre-shipment credit is provided. Now, the basic of this credit is that how much credit should be provided. So as Professor Saran has already mentioned you that credit is provided based on the cost of production and FOB price of that particular goods. So based on that, that credit is provided. Now I think he is asking about the interest rate in that. So elasticity, see,
elasticity of demand is something different, you see. Okay, it is not concerned with the cost of the goods, I think so.
So basically here your credit is provided on the cost of production and FOB price of the goods. How much is the cost of production and how much is the FOB price of the goods. Based on that, on the subsidized rate, Government of India provides you packing credit so that you could process the goods and package the goods easily.
I think you are talking about the pricing of the goods. That is based on the elasticity of demand. Okay. Hello?
Yeah, now let us proceed further.
Now, so this post-shipment credit is also available in the local currency and as well as in foreign currency. So, foreign currency, I have already explained to you that if the exporter gets the foreign currency credit, the interest rate may be lower, because if you compare the interest rate in different markets, in India and in other markets, in some of the markets, in dollar markets, in euro markets, the rate of interest has been lower than in case of India. So even if you get LIBOR plus 1%, you have to pay LIBOR plus 1% interest rate. It is normally cheaper form of credit, and moreover you get the foreign currency. So the post-shipment credit is also given for a period of 180 days. Now in some cases where the deferred payment system is involved, the banks give or extend the medium term credit for a period of 1 to 5 years. And the banks extend credit to the exporter, the banks extend credit to the importer. One is known as the supplier's credit, the other is known as the buyer's credit. The supplier's credit is found in cases where the importer makes the payment for the goods in installment. So if the installment extends to 4 years or 5 years or 3 years, in that case, the exporter is lacking finance, necessary finance to produce goods for further exports. So in that case, the exporter borrows credit from the banks, which is known as supplier's credit. It gets the payment from the importer, and accordingly, in different installments, it makes the repayment. This is supplier's credit. There is also buyer's credit when the importers borrow from the bank. Normally it is the exporter's bank. In this case, the importer makes the payment for the export in lump sum in the beginning. But if they do not have the fund, they go to the exporter's bank and borrow funds to make a lump sum payment to the exporter. And they repay the loan in installments. So in case of buyer's credit, the installment payment is made to the bank, exporter's bank, because the exporter has already got this money in lump sum. The importer has borrowed from the bank, it is making installment payment to the bank. In supplier's credit, the exporter borrows from the bank and repays the amount in installments to the bank. Now, lastly, we have factoring and forfeiting. The exporter draws a bill on the importer and sells the bill to its banker. Bank buys the receivables and collects the payment from the importer after a specified period of time. So in this case, the credit risk is borne by the bank, not by the exporter. Forfaiting is just like factoring. It is normally non-recourse financing. Non-recourse financing means if the importer defaults, in that case, the loss is to be borne by the bank, not by the exporter. So it is a sort of promissory note. Importer issues promissory notes, gets avalized by its banker. Avalized means confirmed by its banker. Then the importer's bank passes on the promissory note to the forfeiter, which is normally the exporter's bank. The exporter's bank then passes on the promissory note to forfeitist, which is normally exporter. Then the exporter ships goods, gets cash from the bank, from its banker, forfeiter, on the basis of the promissory note, and finally the forfeiter or the exporting bank collects the payment from the importer.
Yeah, now the time is very short, and you have already learned about how the payment is made in the export business and what are the different sources of finance, that is pre-shipment and post-shipment credits, and the mechanism of this credit. Thank you very much, Professor Saranjay, and thank you very much, participants. And we will be again back at 2 o'clock and 2 to 2:45. We have another session. Today we have 4 sessions for this commerce programs, that is for BCom and MCom program. Thank you very much.
Thank you very much.